This conference will now be recorded.
Okay, so you should have finished those and turned those in. I didn't last time, but things not on time today. I will take off points. So you're supposed to have
Professor,
them.
you're taking off points, but it says it's due at 12. Like,
It says to do it 12 on there, but I told you it's 15 minutes. It's just the increments that it comes in. We're now on this material here. I gave it time 15 minutes.
yeah, I understand that, but I was letting you know that my laptop was
We're moving on. We're moving on. We have the cash cycle that we've talked about with cash in the bank, used to purchase inventory. The inventory is sold. A lot of times on credit. The cash is used to pay accounts payable and other expenses. And we have the remaining cash in the bank. So that's the cash cycle. And we said keeping track of cash was a very important function that a business has to do. That's one of the key. You have to control the cash. Internal controls have to be set up. Here's your internal control process here. Control environment, activities, information communication, monitoring, and then risk assessment. We talked about the fact that the Sarbanes-Oxley Act was passed because a lot of companies were engaged in fraudulent activities. And then we moved on to bank reconciliations. And we said in preparing a bank reconciliation, there is a company analysis where we look at the balance per the checkbook, we add unrecorded deposits, we subtract out service charges, and we get the correct balance. Then there was a bank analysis where we started with the balance per the bank statement. We added deposits and transits, we subtracted outstanding checks and other withdrawals that the bank didn't have to get the correct balance. And the goal was a correct balance in each situation. We did A and B, so now I want you to work C on this bank reconciliation practice problem. So everybody fill out the C portion of this now. We did A and B last time, starting with the balance. So we're starting with this company analysis first. So begin to work and get the correct balance for the company analysis. Then I'll flip it up so we can move on to the bank analysis. So if we're doing the company analysis, what's going to be the first item on this analysis? What's the first item going to be on this analysis? Possibly.
The balance per books.
Balance per the books.
So it's 29,500.
Okay. Then we're going to pick up items that are not on the books. And so we go first to what? Interest credited by the bank that we don't have. Then we look at expenses charged by the bank that we don't have. And so our correct balance based on this analysis would be what?
31,000.
31,000. Any questions by anybody on how we got that 31,000? We're just doing a simple bank reconciliation. Now, so the bank is, the company has its books, it's done its analysis in terms of what's the correct balance. Now we go to the bank because we want to make sure that there are no errors on the bank. And so we're going to start that bank analysis with a balance per the bank, 30,000. So what else is going to go on the bank analysis?
The deposits?
The deposits in transit. So we're picking up items the bank doesn't have. So deposits in transit, they would not have. And they also would not have what? Outstanding checks. So 30 plus the deposits in transit. The bank has the 30. It doesn't have deposits in transit. We add that 34. We subtract out the outstanding checks, and we come back to 31,000 as the correct balance. You also have to make journal entries, and the company is making these journal entries because it doesn't have these items. And so the interest income, it would make that entry, debiting cash and crediting interest income because the bank gives that income to them. And they don't have it recorded. They have to record it and post it. And then the service charges by the bank. That entry has to be made also. So this is not a difficult as we work with these simple bank reconciliations. Then we talked about a complicated one where JHJ Roan Car Company deposited 100,000, and it's showing the deposits by week. It's showing the actual checks that were paid, and it's showing the books ending up with this balance. The bank statement arrived with certain different things on it, and we want to come to the correct balance given that ending balance. And so for the A students, you're to study this and make sure you can do a complicated analysis. So review this, review the points, those journal entries that were made, including the correction for that error. Okay, let's look at our bank reconciliation homework. Let's do on Tuesday. Each team will turn in the homework. One person per team will turn in the homework. So need a team leader. Team leader, what you would do would be to include only people who submit you a copy of what they did. So if people on your team do not submit anything to you, then you're not to submit their names in, because when I give a test and if people are listed as having done this work on your team and they don't do well, then I'm going to come back to you to check why did that happen. So you want to be a team leader, be a team leader. If not, then don't be a team leader, but you got to hold people accountable. So this is not difficult work to look at it. A lot of it's just multiple choice, but everybody works on it. Here's the bank reconciliation comprehensive problem, A students only. So A students, you will work this bank reconciliation comprehensive problem, and you will submit this in a separate link that I'll set up for the complicated bank reconciliation. We next looked at cash flow statements. And in cash flow statements, we said there are three types of activities: operating, investing, and financing activities that involve Operating activities are like your salary. Investing activities are like the assets that you buy with your salary, and financing activities represents having received loans and etc., paying those loans back. In the case of a corporation, paying dividends to the owners. And so we said when there's a cash flow statement for a company, this is the key thing to know, that a company is supposed to get its cash from operation from its sales and its current assets and its current liabilities. That's where the cash is supposed to be. If it does not have cash from operations, that's an issue. So that is the concept that you're learning, that a company needs cash from operations. In the second course, we actually will look at some cash flow statements and analyze how those companies are doing. We're just getting the basics down now. Investments represent the fact that a company is supposed to expand or do R&D so it can stay on top of the market. This number should be negative. If it's positive, then that can be an issue, and that is non-recurring income. Their recurring income only comes from operations. Financing involves how the company is financed. The company is financed by the owners contributing stock or contributing cash for stock and borrowing. And after the company's been in existence for a while, we want to see them paying off indebtedness, just like you personally. Once you start to work, you want to pay off student loans and any other loans you have. And then we want a change in cash to be positive. So cash generated by operations, investments negative, financing negative because we're paying dividends to owners and we're paying off debt, and a positive increase in cash from the company. We have a direct method of preparing the statement of cash flow. It's just a template type of thing. These are the journal entries that are in operations, and only journal entries that are utilized are 1 through 11. If the journal entry is 1 through 6, it's a source. If it's 7 through 11, it's a use. And so this shows if you have a transaction, where the amount of that transaction goes so that we can prepare the statement of cash flow. And as long as we just have a few cash transactions, we can utilize this method. Cash flow from investments, journal entry 6 comes here if we sell an asset, the amount of the proceeds. If we purchase a long-term asset versus a short-term asset, that asset goes here. Current assets, current liabilities are up here. Long-term assets are up here. If we sell them, it's a JE6. If we purchase them, they're JE7. And we like to see purchases of assets in terms of expanding. Cash flow from financing, journal entry 1 comes here. When you contribute cash to start the company, that's a good thing. But if that happens, then there should be some JE10s. And what is JE10? What is journal entry 10?
Payment of dividends.
Payment of dividends.
Right. Oh, yeah.
Thank you, Cameron. Okay. So
Real quick, by journal entries, do you mean like, is that on a transaction type sheet?
Yep, those same ones.
Oh, okay. That's why I was confused. I'm like, what do you mean journal entries? So use the same transaction type sheet, but now you call them journal entries.
Yeah.
Okay.
So these are the journal entry types. And we looked at this problem last time, and we said that what? If it was not a journal entry 1 through 11, we scratched it out. We weren't going to use that in preparing that statement of cash flow. Then we went to journal entry 1, which is a contribution of cash. That is a type 1 journal entry. It's going to be cash flow from financing. So this is where you put your money in. That's fine. But if you are looking at a company, you aren't concerned with what people put in. You're concerned with how much is in operation that they earn. And so when a person puts money in the company, that's financing. And they're asking you to finance because eventually they ask you to make a decision. Are you going to give this company your $1 million as these other people did? So that's what we ask you to do. And so your money will be down here. You only get a return if you sell it or if there's a journal entry 10 where dividends are paid. But that's not an expense. Then we went to journal entry 2, cash sales, 1,200. The only part is we concerned with it, that cash. And that's going to be a type 2 transaction, which is in the operations 1,200. And then if we look at go around the journal entry 9, where we collected on cash on receivables, once again, that's going to be an operation as a source. Now, looking back at the problem, when we made the sell on account, we don't count that. We only concern with when we collected the cash. So this is a different way of looking at it, but you've got to be able to determine whether a company has cash from operations. We purchase supplies, we pay salaries. So 5 and 6 are going to be those operating items. For journal entries, 5 and 6 are operating items. JE7, we paid a liability. JE9, we paid an expense. Okay, so that just covers purchasing, paying cash for the supplies, and paying salaries. The different one was when we purchased equipment costing $600, paid cash down $200, and signed a long-term note for the balance. So we said we want the $600 cost in there, and we want to show that. And so in showing that, we show the $600 cost, but we also show a $400 loan. So transaction 7 is in 2 parts. We purchased equipment for $600. We paid cash down of $200. That's in here, but that's offset by the fact that we signed a long-term note for $400. So the cash flow statement needs to reflect both things. It doesn't need to reflect the fact that you paid $200. It needs to reflect that you bought $600 and you owe $400. So that's a little different. Paid on accounts payable. That's once again payment of a liability. That's going to be up here in the top. Collection of accounts receivable, $500. We talked about that. Paid on a long-term note, $200, and paid a dividend. When we pay on the long-term note, it's going to be here, $200. When we paid a dividend. So long-term transactions are down here in financing as we are separating those from the short-term transactions. So that's what we're doing. And the final transaction we had was we sold equipment costing $250 for $100. The only thing relevant is the $100. So we get the $100 and we pay it here. So in preparing this simple cash flow statement, we're going to come to part one, operations. We add the sources, we add the uses, and take the difference. And I put in extra zeros. Our net is $700,000. That's a good thing. If a company doesn't have positive here, that's a problem, especially if it seems making net income. That's the problem. Investments, we sold one item, we bought an item for $600. So our investments is a minus $500. So that's what we, sort of want to see. In the financing part, we contributed $200 and we borrowed $400, that's $600. We paid a dividend, paid on it $300. So the net is $300. So our change in cash, 700 minus 500, 200 plus 300 is 500. Okay, any questions? In the beginning, cash would have been the 200,000 we put in, less the 700 in it. But the 500 is the key. That's the end.
Yes, Professor. I have a question. I just kind of like I'm a little like lost on this. I just wanted to know if you could like go over this one more time, this like specific part, because I'm kind of lost.
Kind of lost. Okay. Why don't we work another problem? Okay. So would that be easier
Okay.
rather than the same problem? Because we
Okay.
can start at the beginning and go over it, okay?
All right.
So we got one work. So we'll work another one. And for homework, team 2, this is your problem. We'll do one. So this team 2, this is your problem. 4-2. Team 3, this is your problem. Team 4, this is your problem. And team 1, this is your problem. Got it? Once again, on the cash flow problems, team leaders, you collect a problem from everybody. You get it right, then you send it in. If they don't send you to work, then you don't put their name on it. Because eventually they've got to do it on their own. Okay, so here we have 4-1. So this was the problem team 1 was going to get, but now we'll work it for them. And then since they have this extra knowledge and all of those A students on team 1, we can give them an appropriate A homework.
I mean, you didn't have to go over this one. I just wanted to know what you were talking about at the last part. I mean, we could still have our problem. I just wanted you to go over like the example that you were talking about before.
Nah, then you'll really know
Oh my God.
Okay, so what we're gonna do we understand the basic concept that what we're trying to do is to, and that's the key thing, first of all, we're trying to see if the company has cash from operations. let's make sure we understand what we're trying to do. When you look at a company, our documents, if you're looking at a significant other, and there are 3 significant others, and you're evaluating them for companionship, so you got a choice here. Each significant other has $100,000. Significant other A has $100,000 because he saved salary of $100,000. Significant other B has $100,000 because he sold all of his assets. He sold his house, his car, and everything, and he has $100,000. And then significant other 3 has $100,000 because he took out student loans, and he also, he sells a few little smoking things on the side too. When he takes out loan, he does things like
Lord.
So which one of these significant others you gonna pick?
The first one, because he saved all his money. These other people are irresponsible.
All right. So the thing here is with a company is the same thing. You got to be able to evaluate all these companies out here. Okay. Your mother wins $100,000 at the lottery. She says, well, you got a big time degree in accounting from Texas Southern. What you gonna do? Invest my $100,000 for me. Where you gonna invest her $100,000 at? She said, I want a good return. If you put it in the bank, what, 0.1%? And she said, that's not good enough. So where you gonna invest her money, Dawkins?
You said, where would I invest her money?
Mm-hmm.
What are the options? Like, what are my options?
The option is she says 0.1% from the bank's not good enough. Now you got a degree in accounting. I paid all that money for you. Tell me where I can invest my money. I won the lottery, so I can make money grow.
She could invest it in me, and then
Oh,
on business. Well,
already
I
done
don't know, like in a different company. I don't know in the.
Okay, you someone investing in a company. Well, you got to be able to. Okay, so you can't just go out and pick a company. You got to look at the company's financial statements. Okay.
Oh yeah.
And so that's what we're looking at. And you got to be able to accounting and finance majors pay to look at a company and see if it's going to be profitable. And everybody, if you're going to work for somebody, you might need to look to see if they got any operating money to see if they're going to stay in business. If the company don't have any operating money and they got cash flow statements. So that's why we do it. And we'll get back to maybe looking at some companies next time a little bit. So what I want to do, Doc, is just start at the beginning with a new one. Let you work it for us. But I appreciate it because you're probably doing a good thing for somebody else, like Miss Williams, who just hadn't had time yet. Okay, so and I got this template out for you. So first of all, you need to understand what we're doing. I hope you got that now. So, oh wow, this one's in here too. So let's get the clean one, Dawkins. Copy it. And we're going to paste this clean one above this problem. Okay, so I got the clean one above the problem. So we're going to go journal entry by journal entry in full one and see if it goes on the statement and where. There are 10 journal entries. What's the first one?
The invested $200,000 to start a company, so common stock in cash.
Remember type first.
Oh, one.
So this is our JE1. So we know that that's going to go where on the statement? In part 3, right? Because that's how we finance the company. So we got 1 here, JE1, and the amount was how much?
200,000.
Thank you. Any questions? Does everybody see what we did?
So I have a question. So why? Okay, so it's supposed to go on financing, but why wouldn't it go on investments if they're like investing money in the company?
Investing, is defined here, are investments the company is making.
Oh, okay.
Okay, and so financing, that is investing to you, but for the company, it's financing. So you got to look at, I run this company. What kind of assets am I going to invest in that are long term? They go here. Where did I get money from people to help finance my company? That goes here. So you're looking at it from the standpoint of you own the company, okay? And Kayla Williams, you're trying to get her to invest in your company.
Okay, I got that part.
What we're going to do with number 2?
That's supplies and accounts payable, but the type is.
You're supposed to have that memorized. Cameron's supposed to help out.
Type is going to be 12.
Well, now I'm just trying to learn.
That's a type 12, so we're going to strike it out. We only including types 1 through 11.
See, that's what I had a question about. Okay. Okay, so that's because I was like, why the strike through, like, why are there only like certain ones that are supposed to be like left out?
Why I worked another one, got it? So you'd see it better. And then I could give you that hard one. Okay, here's your favorite example here. Purchase 5 cars for $10,000 each, paying $10,000 down and signing a note for the balance. What we're going to do here, what are our types?
Well, first the type is 7 and 12, I think. Yeah, 7 and 12. And oh wait, so wait, if it's 7 and 12, then do you only include 1? Because you said it's 1 through 11.
I didn't say that. You said 12. Come on. Okay. 2 things are happening here as you look at this. You're buying a car for $10,000, 5 of them, so you're gonna pay $50,000. How do you get this? How do you get this $50,000 for the car? First of all, there's a JE7 where you pay cash or what? $10,000.
Right, but okay, so what would be the other one? So you don't include the signing the note?
Yep. but that's going to be a JE5,
Oh, oh, okay.
which is you actually borrowed money from the bank to buy it, and you got the cash, and then you bought it too. So it's two transactions here. Well, three
Okay,
had.
so I'm confused now.
That don't make sense because when we're doing journal entries, we say it's type 7 and 12. Sorry, I'm eating, so excuse me.
Right. That's what I was confused about
But
because
it
I was
said
like,
we
you
in
trying
the
to know.
so it's a type 7 and 5. We're supposed to just assume we got money from the bank and then bought it with the money
Yeah,
we got from the bank.
we look at it that way because if we don't look at it that way, you would show on the statement that you bought $10,000 worth of equipment or cars. But the key is you bought 5 cars for $50,000.
So why we are doing this differently than the way we did it?
It's the usefulness of the information. So it's J7, right? What you need to know when you evaluate this company is that they bought $50,000 worth of cars. Okay, you don't need to know that they bought 10,000, they paid 10,000 down. You need to know that they bought $50,000 worth of cars. So that's transaction number 3. Got to look at what you got to know. So you can't always say, well, we did it that way. Yeah, but it's the usefulness of the information and what is more important.
So if we use $50,000, because as you say, like we don't need to know like how much they put a down payment. So how can we know like they put a down payment of $10,000?
Said it in the problem. Said they paid 10,000 down. So in this particular case, just for the statement, because we have to look at things differently. The other part is that they owe $40,000. Okay. So you could show it as they bought a car for $10,000, or you could show it they bought 5 cars for $50,000 and they owe $40,000. Which information is most useful?
Sorry, the second one to me.
Say what?
The second one?
Which one?
Where they bought the 5 cars for 50,000 and they owe 40.
That's correct. So that's why we do that. If your significant other went out and bought a car that cost $50,000 and he told you he paid $10,000 for the car, what would you say? When a month later he says, I need you to help me make these payments. Okay. So for a business, you need to know it's $50,000, and you need to know that down the road, $40,000 got to be paid back. That's the useful information. Okay, that's a little different. Just work on that. What we're gonna do for number 4, Dawkins?
Received cash for rental revenue of 500,000. Okay, hold on, because I need to get my paper with all my charts.
Supposed to have these memorized. Cameron,
Yep,
which journal entry is this?
that was. Hold on, I need to get my sheet in front of me.
Oh, that's the second.
Wait, which one was it?
2.
Was
It's
it
on 2.
number 2? Number 2?
Yeah.
Push supplies. Number 4, number 2.
Receive cash for run revenue. Oh, we're on number 4.
Okay, that's what I thought.
Okay, we're just saying the type was 2. And so we know that a 2 is going to go where? That's operations. 4 JE 2. How much is that money? Full 500,000. 500,000. Any questions? Any questions?
Yeah, so these like these line of accounts, like you have the cash flows from investments and financing and all that. So the way they're going in order is based like the journal entry type. So it's always going to be like that. So the type 2 handles 3 and 4 of like the journal entry types, and the cash flow, which is I guess the account type 1, handles like journal entries 1 through like the journal entry types 1 through 2, or is it just like you're just placing them?
Going where the journal entries go.
Oh, okay.
Journal entries 2 through 5 are going to go in operations. 5 if it's a short-term liability. Journal entries 7 and 8, current asset, current liabilities, 9 and 11, they go on the use side in operations. So we're showing if you got a transaction, is it in operations? To be in operations, it's got to be here or here. Source use. So this chart here becomes very important. So you need to make a copy of it and have it handy as you work in these. If the journal entry 6, sale of a long-term asset, it's going here. If you purchase a long-term asset, it's a JE7, it's coming here. So it is important to have this handy. So this is the template that shows you where those journal entries go. A journal entry 1 or journal entry 5, just like we did that, a long-term liability goes here. When we pay on a long-term liability, it's here, dividends are here. So this statement of cash flow direct format, this shows you where each of the first 11 journal entries go, and it's only the first 11. So having said all of that, and going back to 4-1, so we've done 1, 2, 3, 4. All right, you all do 5 and 6. You all do 5 and 6. Y'all got them done? Well, can anybody tell me the type of paying rent expense and paying salaries? Can anybody tell me the type?
That should be a type 8.
I said
I
9.
think it's type 9.
Yeah.
So these are type 9s.
Oh, both of them? Well,
Pay salaries.
okay. So, okay. Sure. We'll go with it.
So if you go on the sheet, where's type 9 located? On the template. Type 9 is here in operations. So what are we going to do with those two then?
Wait, type 9 is a use.
Yep.
So it goes under the cash flows from operations. The first part.
So this is correct. So we have transactions 5. We have transaction 6. They both are JE9s. So how much was transaction 5 for?
$20,000.
How much?
20,000.
20. And how much was 6?
It's 10,000.
Okay. Let's see if we can go to 7.
Professor, I have a question.
Okay.
If you go up there back where we just fill up the entries for type 9, I want to ask you something from there. Okay. How can we figure it out? Like we have to go for the source type or we have to go for the usage? Like, I mean, like use journal entry type.
Okay. And I don't see if I had it on here. Okay. So you got a little bit there. Good question. If you have a 1 through a 6, it's going to be on the source side. If you have a 7 through an 11, it's going to be on the use side. Does that help?
So we just have to memorize it. There is no logic behind it, like why we're dividing them in 2 different types?
Because when cash comes in, that's a source. When cash goes out, it's a use.
Oh, okay, I got you.
So we're looking at this. Good question and good illumination, I'm sure, for most people in the class. When cash comes in, it's a source. It's going to be on this side. Here's a use. So our goal is, do our sources exceed our uses in operations? It's just like for you personally. Does your salary for the month exceed your monthly expenses? That's a relevant question, isn't it? So for a company, it's the same thing. Do the revenues, so the revenues that the company is making, do they exceed the expenses? That's all we're saying. So it's kind of like a net income, but it's on a cash basis. Okay, so going back here now with all of that new knowledge, What are y'all gonna do with number 7? Do y'all know what type it is?
It's a type 9, and it's gonna go. Type 9 is gonna go on the first section of the use.
I think it's type 10, no?
Yeah. Why isn't
Yeah,
it
I
type
thought it was
10?
10 too.
Why you say so? It's a type 10.
Yeah, what they said. I looked at it
And
too fast.
here it go. Remember, a 10 is a reimbursement to the owner. It's not an expense. We're reimbursing the owner for their investment. And so we don't need that up in that's not an operating item. We're paying the owner for his investments or paid dividends of $5,000. So it's important for you to know that the owner put in 200,000, got 5,000 back. Because if you want to put your money in, how much you gonna get back? And it's not an expense. So they have to have income to do that. Okay, we're up to number 8. Don't everybody speak at once.
Well, I'm trying to look for the type, but I know the transaction. I know I'm supposed to have these memorized by now, but
I mean, I was gonna answer, but considering this is group 1s, technically, I don't
No,
want to be giving you too
technically,
many
no,
answers.
they got another one technically. Now, so this is JE what? 8, payment of a liability.
Mm-hmm.
yeah.
And payment of a liability is gonna be, that's a current liability, it's gonna be here. So this is JE 8. So what number was this? This is and it is 8 for 1,200. All right, I'm gonna let y'all do 9 and 10. So y'all got 5 minutes to do 9 and 10. That's 2.5 minutes each. I got those worked out.
Looks like
Okay, paid auto expenses 2,000. What type is that?
9
That's journal entry 9. So where's that gonna go?
is gonna go a use type.
Use where?
Operations.
Already got some 9s there, so okay, 9, and that was 2,000, correct?
Yes.
Okay, and what we're gonna do with paid principal on the note of 10,000 and interest of 5,000.
So here we have 2 different transaction types. For notes payable is probably gonna be 8,
So this is a type 8.
and for interest is because it's an expense and it's type 9.
I don't know why I wanted to do that, but anyway. So the 10 is going to be a type 8 long term, and then the 5, I just put it here, is going to be
9.
JE9. Okay. So what we're going to do with it?
I think notes payable is long term, I mean like liability, so is gonna come under finance.
Mm-hmm.
Okay.
And
Interest expense is probably gonna come under operations
mm-hmm.
and is gonna be under usage type.
Oh, you got that down now. So this is 10, wasn't it? Kind of botch those in. So I kind of botched those in a little bit, but okay. So now we make a determination in terms of what happened in part 1. And do we have operations in part 1? How much do these add up to here? Can y'all add those up?
$38,200.
So what's our net source of operations? Just subtract them.
It's 461,800.
So that's a good thing in terms of what we have from operation. Investments, we have what? Only one thing. So that's going to be a minus 50,000. Because the uses exceed the sources. Then in financing, sources are 240, uses are 15, So that would be what, 225?
5,000, yes, 225,000.
So what's our change in total change in cash? 461.8 minus 50 plus 225. Well, it's gonna be 600,000 or 700,000. How much is this?
$636,800.
800. Okay, so work through your homework. You know, it's a procedure type deal. It's not that bad.
Professor,
So
can I ask you one more thing, please?
yes.
If we got any question which the transaction type is more than 11, so we just can cancel it or what?
Cancel it out.
Okay.
Just scratch it out. So team 2 has 2. Team 3 has 3. Team 4 has 4. And team 5 has 5. I mean, team 1 has 5.
We have 20 questions. Why? Why do we need 20 questions?
Look at it this way, you'll learn more.
Wow.
Well, you know what I'm gonna do? 2 and 3 are really too easy for all these A students we got. So what we're gonna do is this. Teams 1 and 2, you all will do 4. And teams 3 and 4, y'all will do 5. We'll do it that way. Because you won't learn enough just doing us, we just completed that one and you're not gonna learn anything. So
are you breaking it up like teams 1 and 2 have to do like 1 through 10 and 11 through 20? Or how is that?
the whole thing. Team 1's gonna send me a 4. Team 2 is gonna send me a 4.
Right, but I mean of all 21 transactions, or are you breaking it up in
Yes,
half?
all of them. Yes, all of them. Team 3 is gonna send me a 5. Team 4 is gonna send me a 5. You got to know them all. So Dawkins, you've been very helpful today.
Oh my gosh.
I'm sure your teams 3 and 4 and your team, they appreciate they're gonna be able to learn more rather than less. Okay, so once again, teams 1 and 2, you all are doing 4, the whole thing. Then teams 3 and 4, you're doing 5, the whole thing. Okay, let's look at where we're headed now for the course. We're going to review receivables today.
I think that should be enough for today.
We won't do much. We are going to string it too much. The next thing is account receivable cycle. And since you all are pretending y'all are struggling with that bad debt expense, there are 2 types of sales. Cash sales is in the bank. Then there's sales on account. And we have accounts receivable, beginning balance, sales, ending balance. Some people pay. Some people get discount. Some people return things. And other people don't pay. None of y'all in this class. But some people buy things on credit and won't pay for it. So when the transaction is made, we debit cash and credit sales on a cash sale. We debit account receivable and credit sales on a credit sale. Okay. we're not worried about bad debt on the cash sales. We already got it. So when you were making your AJE, you weren't concerned about the cash sales. That money was already in the bank. But what you were concerned about was all of these sales on account. So with the matching principle, when customers make credit sales, then because some people are not going to pay, that's an expense. So if we had cash sales of 400,000, but credit sales of 600,000, we got the 400. But we know from history, 10% of the people not going to pay. They just don't pay. So on the cash sale, debit, cash, credit sales, 400,000. On the credit sale, debit account receivable, credit sale of 600. So we're showing a receivable at 600 and sales at 600,000. But we're only going to get 540. So we're going to make a journal entry debiting bad debt expense. So that's going to reduce the revenue. And then we're going to make a journal entry crediting the allowance for bad debts. And now we create another get rid of the sidebar view. We create another contra account. The balance sheet is going to show the receivable at 600. It's going to reduce it by the bad debts. So the net receivable is 540. So do you see what's happening? And what would happen if you didn't make journal entry 16, which is an AJE? You would be showing receivables of 600, but they're only worth 540. And you'd be showing the sales of 600, and you would not have the bad debt expense in. So that's all that we are doing with that entry. Are there any questions?
Yeah. What do we have that's due on Tuesday? Because I actually have to go like right now. So like, is it just the assignment, the cash flow assignment?
You have the cash flow assignment, and also you have the bank reconciliation assignment.
So 2 of them due on Tuesday?
Yeah. Now let's look at where we're going to go for the rest of the course. We'll look at receivables a little bit more. There's another way to do it, but you can see what was expected is not that much. Inventories will be the last thing we'll cover. Okay. Sometimes people have trouble selling shoes. They can buy them. I'm sure Dawkins has 100 pairs of shoes in their closet. We're gonna see if she can run a shoe store. But before we get there to receivables, on Tuesday, we'll finish up on before we get to inventory, we'll finish up on receivables. Sidebar. A lot of work in here on receivables. Oh. I got a lot of problems to work. Wait a minute. Oh, this thing is acting up. Okay. Next time, once we finish receivables, we're coming to long-term assets. And here we look at how to calculate depreciation, since y'all act like we're so hard. So we had the adjusting entry. Now we'll look at the depreciation method. So we do depreciation next. Of course, you'll have homework on these afterwards. We'll do depreciation, then we'll do shareholders' equity. Then we'll be back on inventories on Thursday. And inventories will take us on through the end of the course. So you need to read the material on receivables, then come to planning equipment and depreciation and stockholders' equity. We'll do that on Monday. The next Tuesday will be on inventories. Any questions? Any comments?
Yes. For this bank